The Empire Strikes Back. Because if you know your Star Wars lore, you remember that incredible movie from 1980. That's the movie where Luke Skywalker meets with Yoda and really gets his like deep training in, where is he? Dantooine, on that like swamp planet. And so the movie is all about his journey towards becoming like Zen-like and controlling his emotions and to think rationally so that he doesn't just react. He can like respond to the situation that he's in.
And I suppose this is a great pitch for our community again, because if you see yourself acting as like a rogue, like lone wolf kind of figure, your emotions will get the better of you probably. Especially now, like, I mean, for I think this is not a compliment, like an app like Robinhood, their business model is to make it more like a casino, to make it easier to push the button. And I've been guilty of this many times.
If you're an investor, you know, it's gone really badly wrong. If literally you lose your house, there's probably other laws you've broken to get into that situation. But take this to heart. If you've got money in your investment portfolio, make sure you got your emergency fund first. This is Wall Street Wildlife. Before we get to this week's show, a short word from our sponsors.
All right. If you're serious about investing, you need to know about public.com. That's where you can invest in everything: stocks, options, bonds, crypto. They even offer some of the highest yields in the industry, like the bond account 6% or higher yield that remains locked in even if the Fed cuts rates.
What sets Public apart is how they give you the tools you need to make informed investment decisions. Their built-in AI tool called Alpha doesn't just tell you if an asset is moving, it tells you why the asset's moving, so you can actually understand what's driving your portfolio performance. Public is a FINRA-registered, SIPC-insured, US-based company with a customer support team that actually cares.
Bottom line, your investments deserve a platform that takes them as seriously as you do. Fund your account in 5 minutes or less at public.com/wildlife and get up to $10,000 when you transfer your old portfolio. That's public.com/wildlife.
Paid for by Public Investing. Full disclosures in podcast description. For an advertising-free version of the show, check out patreon.com/Wall Street Wildlife. Hello and welcome to Wall Street Wildlife with Christoph and Luke. I am back from ski season, back in the UK. It's a delight. Christoph, it's amazing to see you on a big screen again, not some tiny little thing that I travel with. How are you?
I'm doing very well, Badger. Glad to see every time you come back to me alive. It's always a blessing.
Yes, sir.
So thanks for doing that. I'd be one sad monkey without you. I'll tell you that.
Yeah. Well, we have a interesting episode for you this week. You might remember, if you're a long-time listener to the show, that way back at the start of Wall Street Wildlife, we put together our 10 laws of the investing jungle, kind of timeless investing wisdom with a bit of a jungly twist. And so we're going to revisit those today in episode 73. And we're going to give a bit of an alternative spin, though, because we're both fans of pop culture and great movies and amazing TV shows. So we're going to try and bring some of our laws of the jungle to life with like metaphors and stories from existing TV and pop culture that you might well be familiar with. Hopefully this really helps us land those lessons hard.
Speak for yourself, buddy. I'm more of a classical music guy myself. Right. I don't dabble with the... I hang with the aristocracy.
If you want to give us some musical tips as well as we go through our laws, like you feel free, Christoph.
Okay. Hey, pop quiz for you. Apollonian in the streets. How does the t-shirt end?
Oh, if you're on the YouTubes, we're looking at Christoph's t-shirt. Apollonian in the streets, Apollo in the sheets, Dionysian in the sheets. Nice, okay, excellent. Was that bought for you by your beautiful wife? Like thinking of Italy and like Roman gods and her homeland.
Better. I bought it for myself after publishing a recent essay on the Apollonian and Dionysian for my Fire Philosophy Substack.
Okay. All right. All right.
So since I spent a lot of time thinking about Nietzsche's first book, The Birth of Tragedy, I was like, I earned this T-shirt right here. So for anyone that doesn't know what the hell we're talking about or what it means, go read my blog post. I mean Substack post.
All right.
Badger,
I'm
you're
is a bacchanalian? Is that a thing? Can I be a bacchanalian in the I don't know, in the streets probably and the sheets, just drunk everywhere?
That's right. You skip the Apollonian. You go straight to the to the Dionysian. That's right. So how's your time? How would you rate ski season number what, 5?
Yeah, I suppose 4 of the last 5 because COVID killed one. So ski season 4.
Yeah.
Yeah, it was awesome. Really, really good. We did the French Alps. We usually do North America. Like just the scenery was beautiful. I couldn't get my camera positioned to like have like Mont Blanc in the background when we did the last couple of podcasts, but fantastic. And then finished the season nearly 3 months in Avoriaz for Snowbox for a good buddy Ben's 50th birthday. So that was a ton of fun too. Yeah, but I'm back in the UK for about 3 days and played some tennis today, like reacclimatizing to normal life.
3 whole days. Damn. Hey, how does the North American skiing compare to the French Alps? I assume it doesn't favor too well.
I prefer North America, to be quite honest. Yeah. You don't really get gladed runs like trees. You don't really get those in the Alps. I don't know. I'm not a geologist. I don't know why. Maybe it's like to do with the variety of trees that grow. Maybe they grow at a higher altitude. Trees generally grow at a higher altitude, perhaps in North America, or maybe the soil because the mountains are like more mountainy. I got no idea. Like, if you know, like, message me and let me know why that is the case. I'm sure I could Google it. I haven't Googled it. So I like, I like getting in the trees and getting like messy, and that's really good fun. And you can't really do that in in Europe, other than a few like spots that are lower down. And the other thing I love about North America is I like to have random conversations with people on a chairlift. Like, often you're with like a bunch of strangers for 10 minutes. And, I like to have like something a bit more than a flim-flam conversation. Like, often I'll promote the podcast because I got my like Wall Street Wildlife thing attached to my helmet, and someone might in conversation ask me what the hell that is. We've probably got a couple of listeners that way because I like to talk about investing. I like to talk about the show, and I like to talk about you. And in North America, I can do that on every lift. And I know I'm going to be speaking to someone whose first language is English pretty much consistently. Plus, my British accent is an asset in North America. In France, right, everybody speaks English, obviously, but I feel like a moron because I don't speak their language, be it, Swiss German or French or Spanish or some other thing. And so I feel like a bit of a moron. Plus, a British accent in the Alps is definitely not an asset. You're looked at like an idiot because most British people are idiots. Yeah, so the same kind of freedom of expression on the chairlifts doesn't really happen for me in Europe.
That's right. You and the French, the Brits and the French have had a few scuffles back in the day, have they not?
We have, yep.
Right on. Well, it's good to have you back. Where are you off to next?
Sardinia, motorcycle tour of Sardinia in May with some friends, one of whom is a friend's girlfriend. She's awesome fun, and she is Sardinian, and she's a motorcyclist. So she set up this really awesome tour for us where we're going to see the whole island on 2 wheels. And I've never ridden a Harley before. We're going to fly over, and we're all renting Harley Davidson motorcycles. So it's not going to be a quick tour, but it's going to be a fun one, I think. Yeah.
Oh man, I got the idea for you. Like, on your Harley, you got to wear the leather jacket and the big bike. Like, get one of those, what's it called, cruisers or whatever, and then have little badger ears, and maybe a little tail.
Okay, I'll look into that. Let me make a note. Badger on bike. Okay. Very good.
All
right. So we're going to talk laws of the jungle, and we're going to talk investing stuff. But before we do, I think you and I have both got a bit of a company update. and I'll go first. I want to chat briefly about BYD, Build Your Dreams, like the Chinese automobile manufacturer, because you might remember, was it? I think it was our predictions for 2024, and I predicted that BYD would be outselling Tesla. And they didn't, like, it was super close. Like, it was basically like neck and neck. And we've always thought about Tesla as being like the better innovator. Well, I saw some news today that makes me think that like BYD are stealing the crown from them in more ways than one. So BYD have just announced their Super E platform, which is evidently like a ultra fast charger. So I think the current state of the art for Tesla superchargers is like 250 kilowatts. So you can charge, like fully charge your, I don't know, a few hundred miles of range in like 30 minutes, give or take, given like optimal conditions. Is that right? Well,
faster. I charged it in one version 3 or something where it was like 900 miles per hour.
no. Okay. Yeah. Right. Well, BYD have just announced a platform that they're rolling out now of ultra fast chargers that charge at 1 megawatt, which is like way in excess of what Tesla can manage. And so at that rate, I think the demos that they've done say 250 miles of range in 5 minutes. So that's like 1,000 miles in 20 minutes. Well, obviously you'd cap out and it would slow down at the very end, but that's still way faster than Tesla can manage. And that was one of the big Tesla advantages. And thanks to our friends at FinChat, I also wanted to take a quick look at where BYD are in terms of like revenue trajectory. So BYD, like they were primarily an Asian company and now they're selling into the rest of the world. You can see this bar chart of their international revenue versus their kind of local Chinese, like China, Hong Kong, Macau, Taiwan revenue. Like they're now 30% pretty much of their revenues are international. Like they're growing their international presence nicely. And the market cap is still relatively sensible at about, I'm going to eyeball that, about 160 billion US dollars. Like FinChat does some nice stuff with the data. These metrics from finchat.io. Oh, and by the way, if you go sign up at finchat.io/wildlife, you'll get a handsome discount and you'll be doing us a great favor. Thank you. FinChat pull in like a whole bunch of custom metrics, essentially, like metrics that they pull out of the quarterly earnings reports. So you won't find this on other finance platforms where we can start plotting like international versus domestic revenue. And then the other nice thing they do, like this stock is quoted in Chinese yuan. And so there's just a little toggle on finchat.io that allows you to flip it into US dollars. So you can kind of see like for like when you compare it to companies like Tesla. So anyway, BYD's revenues, becoming an international company, I think still reasonably valued. I'm very happy to have this one in my portfolio.
Cool. I don't know why I'm not that interested in it. It could be that it's the Chinese rule number one that I have that served me well for a long time. Maybe I'm too biased on Tesla's end, even though it seems like that's I need to look into some priors, but what's the one thing you would say to me to get me more excited?
In BYD versus Tesla. Well, here's one, right? Who is BYD's CEO? Exactly. I haven't got a freaking clue either.
My God. I see what you did there. That's good. That's good. Yeah, that's pretty good. Okay, sold. Yeah, I mean, just to spell it out, though, the reason I have the China rule, I learned the hard way some time back, invested in things that blew up. But I always think it's like, well, if something does go wrong, what recourse do we have as U.S. investors? And
I agree. Yeah.
I don't know how you solve that problem. You just assume that nothing will happen, nothing bad will happen, right?
Well, one thing you might want to do, because it's an international stock, is maybe not buy the ADR, like the US listing version of it. If you can, I would own this for international investors, I would own it on the Hong Kong Stock Exchange. I think you can't buy the China listing, but you can buy the Hong Kong listing. And I imagine you're going to insulate yourself at least from some of the geopolitical risk.
Okay. Yeah, makes sense. I would just position very conservatively with any Chinese company. That's all. That's on my ledger. But Godspeed to them. I have an update for you. One of our Patreons requested a few words about Avita Medical, ticker symbol RCEL. Why I have a couple of these shares in my King of the Jungle company. It's not that I love this company. It's a small biomedical company that deals with serious wounds. It's that it's all about the fact that it's a small cap, that it's not at the whims of the larger market forces, for better or worse. And I think it has a very strong growth runway ahead of its ahead. At the moment, management has basically under delivered. The you got to think of it this way. You make a good product, in this case the toolkit that allows surgeons to perform operations on people's wounds, but you also in the medical industry need salespeople to go out and convince more and more doctors to use your better product. And dealing with healthcare and hospitals, it's not an easy sell. I'm not a professional salesperson, but there's all kinds of issues that come up. So I don't know if it's the fault of Vita Medical or the larger healthcare industry and the hospitals having budget shortfalls or whatnot. But for quite a few quarters in the last 2 years, management promised a whole lot and then came way under. So right now, Wall Street is rightly so a little bit skeptical. We don't know what to believe because of these underperformances. That said, the company grew at 29% in 24, which is fine. For a small company, it's decent. But on the latest call, they're projecting about 103 million in revenue, which would represent 61% growth. Now, 61% growth, that now we're talking if they can deliver. At this point, I'm just thinking to myself, they know they've fallen short with their estimates. For them to put out this number and then not meet this one after having egg on their face, it seems like that would be quite a stupid blunder. So I'm feeling pretty confident that they can meet that. So at the moment, it's a $236 million market cap. They recently added two new products, newish, more or less, to their fundamental resell machine. Think of it this way: wounds go deep, especially the bad ones these folks cure. So you got to basically have something at the base layer, then the resell machines go and they add new skin cells to the wound, and then there's a new patch on top that basically helps it heal better. So they've expanded their kind of stack, if you will, of skin burn solutions. And this new stack is at the beginning of its growth trajectory, and it actually has underperformed. Some of these special indications have underperformed as of now, but we're very early. According to their slides, and I know you hold your nose at projections of Tame, but this is a niche, like it's not like you could just say all of the internet, right? I mean, there's only so many burn cases in the world. And so I'm taking their estimate a little more seriously, and they're calling it something like 1.5 billion for a certain kind of wound and 2 billion for an even deeper kind of wound. So 3.5 billion sort of total for down the road. And the market cap again is at 236 million. That's not even taken into consideration vitiligo, which is, I think, concluding its clinical trials, but they're not talking about that much. But that's even further down the road, but that's the biggest market. Long story short is if the sales team delivers and justifies management's forecast, this company will be in very good shape and we should see the stock appreciate handsomely. The downside is they've underperformed recently. They only have 36 million in cash. That's like starting to scrape the bottom of the barrel, but free cash flow and net operating positive should be attained by end of the year. if they in fact meet these sales goals. Last little bit that I can't speak to, but international has not been going as well as expected. And I think some of that has to do with European regulatory uncertainties, which ought to be settled in the second half of 2025. So all of that combined, Badger, is I'm happy holding just a few percent of this in my portfolio. It's one of those small companies nobody really pays attention to, but has a lot of upside if they just meet their guidance.
Great stuff. It's not one that's, I think I owned options on it for a while because I was backing some of your ideas. So I don't think I own that one currently. So not in my radar, but they're doing good work.
Yeah, what I would say like pure plays, because you're really looking at a small company and it's easy to wrap your mind around as opposed to like monsters taking over the whole world. It's a good way to train your investing skill set is maybe what I'm saying. And there's often in these underlooked companies that serve a particular niche, there's often massive room for not just growth, but overperformance. So this is one I've studied for a few years now. I'm comfortable with it. And I like companies that end up where you feel like the ball's in their court. Can they execute? Can the sales team execute? The product's there. The FDA is there. Those are risk reward odds I like. I just wouldn't go, this is nothing like some of my really high conviction ideas. This is almost like a hedge, I think of it.
Yeah, fair enough. Fair enough. Yeah, it's good to be diversified. And, diversification is one of our 10 laws of the jungle.
It is. Are you gonna talk to us about that?
I am. I'm going to get to it. So, if you've been listening to the show for some time, you will be familiar with our laws of the jungle. But really, headline, like, what were our 10 laws? Protect your essentials, know your investment comfort zone, focus on the long game, chart your own course, tame your emotions for investing success, thinking you're smarter than the pack is dangerous, build a resilient portfolio, there's your diversification, understand the deadly perils of leverage, resist the urge to rearrange your trophies, i.e., like don't sell your winners too soon, and build wealth on fundamentals, not rumors. So those are our 10 laws. If you want to go read them, like they are timeless laws, and you can find them at wallstreetwildlife.com or at patreon.com/wallstreetwildlife. Even if you're not signed into our Patreon, it's there as a freebie download, so you can go check it out. So we're going to revisit those 10 laws today's episode, and we're going to give them a bit of a pop culture twist because, Christoph, I think I've got a movie or a TV show that really brings each of these to life. So let's dive into them.
Yeah, no, this is great. And just listening to you going over them, it's so obvious in hindsight after 30 years of doing this, when things have gone wrong, I could tell you exactly which law was broken. And this is one of those things that you and I yap about. I guess this is our bread and butter. Like, these are serious. If you were to follow all of these, you would do incredibly well in the stock market. But some of them like look simple, or they sound simple, or maybe they are simple, but to actually truly understand them, think about them, and find ways that you are tempted to break them or have broken them, and the thing that needs a little tweaking, that requires some legit work and clarity. So I hope we could explain them a little better.
Yeah, well, let's both try and do that today. And like, I'm breaking some of these laws like today, like I know I am. And I think I'm being too smart for my own good. It's going to be my undoing. I know it is, but at least be conscious where you're going a bit off piste and you're doing something that historically probably isn't going to work out. At least know that you're doing that as opposed to doing it blindly.
Yeah, be a smart idiot. Don't be a dumb idiot.
Yeah, totally right. But I think this first law is immutable, and I never break this one, which is protect your essentials. And so really, I'm not going to read the whole law. Go download our PDF and you can read it in detail. But the headline of this one is really like, never invest money you're going to need in the next 5 years. Maybe 5 years is a bit long. Maybe you can come a little bit shorter, but make sure you know like the money that you need to operate your life. Because if you invest that money and if you get caught at the wrong part of the cycle, or you make a bad decision, or a company just kind of blows up on you, you might find that your actual like day-to-day life is impacted. And you know whose life was really impacted in a particular movie was Chris Gardner, played by Will Smith in The Pursuit of Happyness from 2006. Are you a fan of The Pursuit of Happyness? Have you seen the movie?
I have not.
Oh, wow. Oh, it's an incredible movie. Every movie we're going to talk about today are big movies, great movies. This is it's a good Will Smith movie before he became like bad Will Smith for slapping Chris Rock.
Oh, how fast the world changes.
Yeah. Well, so like it's not core to the movie, but the character Chris Gardner, like Will Smith's character in the movie, essentially like is down on his luck. He ends up destitute, like living in like a locker on a tube state on like a subway station with his kid, and then he manages to turn it all around with because he's a super smart entrepreneurial kind of guy and ends up getting like a great job in a finance firm. But the reason this law comes home with with this movie is like the reason the character ends up in these dire straits is he takes all of his money at the setup of the movie and invests it in bone density scanners, I think, like some bit of medical technology. And yeah, and he's not able to sell them. And he's like put all of his like the money he needs to basically buy lunches for his kid and run his life into this product. It doesn't succeed. And then he's suddenly on a really bad back foot. Yeah, this is, I think, Chris Gardner, the character, really felt it, ended up literally homeless. Like if you're an investor, you know, it's gone really badly wrong if literally you lose your house. There's probably other laws you've broken to get into that situation. But take this to heart. If you've got money in your investment portfolio, make sure you got your emergency fund first.
There's a second part to this, which is if you're following this law, then you know you're okay. And then you never panic. And if the market takes a severe downturn, you actually probably feel happy because you get to buy more shares for cheaper as opposed to pulling your hair out because that's your livelihood. It just makes investing better if you don't violate this rule. And I have violated this rule. I think I've violated all 10 at some point or other. I mean, 35 years or whatever, doing something, you're going to break the rules. But
Yeah.
This one, you're right. Don't violate this one.
Yeah. And definitely don't violate it like later in life when you have responsibilities. Maybe you got like people who depend on you, like a kid, or maybe you're financially supporting like family members or something. Because you're not just screwing yourself if you burn like your life cash, you're putting all those people in difficult situation too. So maybe you can break this rule when you're young, but don't break it later when it's much more important. You want to pick us up on the second law of the jungle, and I'll tell you about my movie link.
So let's see. Number 2 is know your investment comfort zone. Understand your risk tolerance. So I think the poker analogy here is good. Let's see. By definition, investing is risky. Poker, like it's a game of what? Odds, probabilities, no such thing as 100% hit rate, correct?
Yeah.
So you know ahead of time you're going to lose. Aces lose all the time. But it's one thing like walking into a casino and sitting down, say, at the $1, $2 table versus sitting down at the $100, $200 table. And when you lose in both situations, I think it like you probably ought not have been at the $100, $200 table if you're not in the right, if you don't have the right skill set, or it's not the right time in your life, or your bankroll isn't big enough, right? It's almost, I translate this like know yourself and know how you're going to react when things don't work out so that you don't panic and you just continue, right? You just continue the process and you continue introspecting, and you then, once you have a base around that, you can see if you need to adjust it, right? If you're always beating the $1, $2 table, you might say to yourself, okay, maybe I could go up a little bit, right? Maybe I could test the waters at the 5, 10 table, right? If you're always losing at the 20 table, well, maybe those are, you're out of your element. Maybe you got to walk back down and continue tweaking and adjusting. How's that sound?
Yeah, that's good. I think. Yeah. And you're weighing up. Like it's natural human behavior, right, to want a certain level of risk in your life, which is why some people do like insanely risky things and some people live like a much more comfortable life. And we all want to be like risk neutral, not risk neutral. We all want to have a life like you can have too little risk. Like we talked about this in a recent conversation with Zoe Ross, the our clinical psychologist who joined us last week. You want to have risk, but you want to have good risk in your life. And so being a good investor, sorry, my cat Sushi's come to say hi. Hello. Being a good investor is about knowing your own risk tolerance and being aware and kind of balancing that off against reward. Now, I think my movie linkage here is, have you seen Free Solo? You familiar with that movie?
Have I ever? Like, my palms have only been sweatier in one other movie. Like, it is the most distressing movie, second most distressing movie I've ever seen.
Yeah, it's pretty wild. If you haven't seen Free Solo, like check it out. It's an incredible movie from 2018. It's about a climber, like a world-class climber called Alex Honnold, and he climbs El Capitan. That's out your way somewhere, right? It's not that far from Texas.
California, right? Yeah.
And he solos it, like he free solos it. So essentially he climbs it, no ropes, no crampons. It's just like the guy and his like fingertips and toes climbing this enormous edifice, which looks like vertical and smooth as hell. Like who knows how he does it. And so he's clearly a guy who is comfortable having like an extreme level of risk in his life. But at the same time, like in his mind, because of his preparation and his practice and how carefully he kind of approached the project, like planning, he didn't just go out there and go, okay, I'm just going to climb this thing. He planned it meticulously, assessed the risks, and he was able to do this really incredible physical feat of endurance and fear, I suppose, because he was kind of well prepared for it. And the reward for him, like there wouldn't be a huge amount of reward for me personally in climbing El Capitan, because I'd feel like, holy F, like what the hell is this thing? But he felt this was like a really important milestone achievement to be the first person to make this ascent.
My palms are sweating again just thinking about scenes from that movie. And the other movie that I was referencing, same thing. I don't know if you've seen it, Man on Wire.
Oh yeah, okay. I haven't watched it actually, but I'm familiar with it. Yeah.
Oh dear God, that's the guy that tightrope walked between the World Trade Center. And if you could just picture tightrope walking with with air underneath you, it's just utterly insane. And you could say, it's just awful to think about. But they survived because, they practiced, they dedicated their entire lives, still obviously not without risk, obviously, but they understood their risk tolerance. And one thing to note, though, is that life is unpredictable. You can't ever count for all contingencies. So when you're risking your life at one of these things, like what would have happened if, say, like an eagle, flew by either of these guys, right?
Yeah.
And like both would be dead.
I guess that is for that kind of physical feat, like the risk is the reward. For investors, we accept risk if we're smart investors because we feel there's a disproportionate reward. I mean, if we'll just be really capitalist about it, right? Stock go up, make money, but the risk that stock might go down, lose money. So we want to kind of balance the probability and the magnitude of those things.
And for transparency purposes, my portfolio right now in the King of the Jungle is pretty, I wouldn't say it's Alex Honnold level risk, but they're pre-revenue companies with lots of promise. And I've done massive amounts of due diligence. Until you finish the job, palms are still a little moist.
Right on. Our third law from the laws of the jungle is focus on the long game, which was essentially about identifying companies with proven track records and potential to solve like long-lasting problems in the future, taking a long view, not looking for like a short-term buck, a quick buck. And I think it might be the number one movie on IMDb, and deservedly so. The Shawshank Redemption, I think it really brings home Like I weighed this against the Count of Monte Cristo, like two characters who take just an incredibly long view on how they're going to achieve their goal. And I can't believe anybody listening to this podcast or watching us on YouTube hasn't seen the Shawshank Redemption. If you haven't, go check it out. But would you agree with the analogy? So you've got like Andy Dufresne, he's been wrongfully imprisoned, and he sort of comes to terms with the situation, makes the best of it, and then takes a very, very long-term view, a plan on how he's going to escape, essentially, and also take down the warden in the process of escaping. Yeah, his slow, steady, meticulous kind of tunneling. I don't want to. Sorry, spoiler alert. If you haven't seen the movie, bad luck. Can you spoil a movie that's like 30 years old? I don't know. Anyway, I just did. Yeah, I think that's a good example of like taking a long-term view. And as an investor, taking a long-term view can be incredibly powerful. Well, in fact, I think essential. All right. If you're serious about investing, you need to know about public.com. That's where you can invest in everything: stocks, options, bonds, crypto. You can even earn some of the highest yields in the industry, like the 6% or higher yield you can lock in with a bond account.
Public is a FINRA-registered SIPC insured platform that takes your investments as seriously as you do. Fund your account in 5 minutes or less at public.com/wildlife and get up to $10,000 when you transfer your old portfolio. That's public.com/wildlife.
Paid for by Public Investing. Full disclosures in podcast description.
Wall Street Wildlife is brought to you by the Chit Chat Stocks podcast. My name is Ryan.
And my name is Brett.
And we're the hosts of the show.
On Chit Chat Stocks, we are constantly researching new stocks, from high flyers to undiscovered small caps, diving deep into business models, debating competitive advantages, dissecting valuations, and we have a fun time while doing it.
Supercharge your investing research and start listening to the podcast today. You can follow the Chit Chat Stocks podcast on YouTube, Spotify, or Apple Podcasts. Follow the show so you never miss an episode. That is the Chit Chat Stocks podcast.
You know what I love about this analogy? It helps people like really visualize what this might feel like in their own lives as investors, because it's hard to imagine 10 years, right? You say to yourself, you know, when the market's going up and down every day or every minute, to truly take that minimal of say 5, 10, 15, 20-year perspective, it's hard. It really is hard. I mean, we're finite mortals. There's that, right? We don't have all the time in the world. But this movie, yeah, like it's been years, a long, long time since I've seen it, but I could visualize some of the faces and some of that, like, okay, this is the situation. I'm not going to fight it. I'm going to like go with it. And I'd rather be, yeah, there's something quite apt, I think.
Yeah. And you know, like Andy kind of, you don't see it, but him kind of chipping away and building his tunnel over the course of like a decade plus as he kind of plans and makes his way towards escape. Like, that's directly analogous, I think, to, you know, being meticulous and making small decisions which over time are going to add up to a huge reward in your portfolio.
Yes. And last point about this, man, if you're listening to us, especially if you listen to us about the episode about investing for your kids, if you're 20 years old or 25, think about it. Even 20 years, right? Even 20 years, which might to you seem like an infinite amount of time because that's your whole lifespan doubled. But then you're only 45 when you're free out of the financial prison, so to speak.
Right.
So in one perspectival sense, yeah, it's a long time, but in another, life goes fast. And before you know it, you know, you're out. So it's the slow and steady, little by little.
Don't like underestimate the long-term benefit of these small decisions you might to make today. And like, as we said in our How to Get Started Investing episode quite recently, like the most important decision is just get started, right? If you haven't got started yet, what are you waiting for, quite honestly?
Yes. So the next law of the jungle is chart your own course. And by this, we were talking about this concept that you really should know what you own and why you own it. And it seems like almost obvious, like, yeah, duh. But it's shocking to me and to you, I think, how many people buy things just because they heard somebody else bought it, or meme things, and or being invested in a bunch of indexes that you have no idea who, what, where, like just zero either idea or care. And to me, I think to us, it's just fundamentally the wrong way to do it, because an investor is an owner of a business. Can you imagine going to the shop you own on Main Street where you sell X, Y, and Z, and you walk in there and you're like, and you have no idea what you're selling or why you're even there? I mean, it makes no sense, right? Like, no sense whatsoever. But if you act like an owner, then you could tend to your customers and you sell more, and then everything. Like, this is a kind of ignorance to me that's almost offensive.
Yeah.
Like,
It's one that I was guilty of totally, though, for the first probably 15 years of my investing career, because I would never go and read like the primary sources. I wouldn't go and look at the quarterly reports from the company. I'd just read, I'd read it on the Motley Fool, I'd read other analysts on Seeking Alpha, or, whatever sources I was using back then. I'd listen to podcasts like this one and go, oh, that sounds interesting. I'll buy that story. And I feel like that's the most important evolution of me as a professional investor, is actually doing my own deep, thorough research on the companies I own, and then maybe validating it afterwards with other opinions, but getting my own view first. And so a movie linked for that I think brings that aspect of it to life is, that's a film I need to rewatch because it's a Brad Pitt classic, Moneyball from 2011. And Pitt's playing Billy Bean, and this guy essentially sort of reinvents the way baseball is studied, right? And so everybody else, all the other teams, were following like conventional wisdom and picking their teams and like for like managers and coaches. And he went out, Billy Bean went out, it's a true story, and he did his own kind of fundamental analysis on what, like a data-based approach, trying to be objective and scientific about what attributes is it of players that makes them successful, and how do you put those together into like a whole baseball team. And so by essentially ignoring all of the received wisdom and kind of reinventing this space, like he changed the way baseball teams are put together and run.
Yeah, and it's also fun to really know what you own, and like it's really fun to understand the players on your team, and that's no small thing. I mean, it like when you've really invested into your team and players and really built it up from scratch, you give your players what they need. You water your plants better, right? Like, I forgive the mixed metaphors, but you just care more. And when you care more, people do better. And it's easier to spot mistakes. And it's easier to spot the things that are working. And for me, as a lifetime learner, part of the fun of investing, I think, is this game side, is the competition of it, which means you need to know the stats. You need to do the background, or else, you don't belong on the field. So big fan of this analogy too.
And I think what is underestimated about doing your own due diligence and actually really directly understanding what's going on is, like, sometimes stocks go down for reasons that are nothing to do with the way the company's executing, or maybe they make a misstep, like something's happened and the investment is failing. And if you've done your own homework, then you're going to understand why there's a problem. Maybe you'll sell it if it's a real problem that's going to last forever, or if it's something transient, or you see a path through this, you're going to hold the stock. You might even add to it. Ideally, you'd add to it if you really believe the market's got it wrong. If you're relying on like another analyst, or you heard us talk about it on the podcast and you didn't go and do your own research on, for example, why Nintendo is an incredible company, like you just listened to Christoph last week, 2 weeks ago, you didn't do the work yourself, you're going to go, Nintendo's failing. That guy Christoph's an ass. He got it wrong. You're probably going to sell the stock and like probably unsubscribe from the podcast. And maybe you've made a bad mistake. Like, doing your own due diligence, helps you stay the course when things aren't maybe necessarily going in your favor, because you're relying on like your own assessment, not borrowed conviction from someone else.
Yeah, this is so important. I mean, this is what our own business model is, that we run a podcast and we run a small community over at patreon.com/Wall Street Wildlife, where we say to our listeners and our members, basically, look, these are companies we're interested in and we've put in the time and we really like what we see or don't like what we see. And that is only translated as you now have a green light to go look in the places we're looking and begin your own process. That's all it is, right? So it's not financial advice in any sense of the word. It's basically, we're encouraged by this story and think you might find a lot of satisfaction in exploring it for yourself, right?
Great stuff. Yep, absolutely. Absolutely. All right. Our next law was tame your emotions for investing success. And this is really like, be the master of your emotions. Fear and greed can kill your returns. And if you want to really get into this law, literally just check out last week's episode where we went deep on understanding and defining and managing your emotions with a clinical psychologist. And I think I've got a fun movie suggestion for you here for this one. The Star Wars trilogy, but specifically The Empire Strikes Back. Because if you know your Star Wars lore, you remember that incredible movie from 1980. Like, that's the movie where Luke Skywalker meets with Yoda and really gets his like deep training in, where is he? Dantooine, on that like swamp planet, and like the dark side of the Force. Like, Luke has to come to terms with controlling his own emotions, and then he faces a sort of image of Vader, who he doesn't know at that point is his father. There you go. I'm spoiling another movie for you. And, you know, he succumbs to the dark side briefly during his training. And so the movie is all about his journey towards becoming like Zen-like and controlling his emotions and to think rationally so that he doesn't just react. He can like respond to the situation that he's in.
And I suppose this is a great pitch for our community again, because if you see yourself acting as like a rogue, like lone wolf kind of figure, your emotions will get the better of you probably. Especially now, like, I mean, for I think this is not a compliment, like an app like Robinhood, their business model is to make it more like a casino, to make it easier to push the button. And I've been guilty of this many times over the last few years because it is so easy. I mean, you know, like willpower can only get you so far, you know, if you keep encountering the same sort of like seductive qualities. So I love, for example, I really took to heart what you said some years back, Luke, your journaling when you make a purchase, journaling your reasons. But now in our community, there's a way, for example, if you want to make a trade, why not pop over to our community and say, I'm thinking about buying X, Y, or Z, or selling X, Y, or Z, sort of like I did with my ASTS thing, and see what the community members say, right? And see if there's that gap between impulse and feedback, whether 2 days later you still see it the same way. More often than not, it's going to save you money rather than cost you money, right? Yeah. The delay. So the next law of the jungle is thinking you're smarter than the pack is dangerous. Byline, stay humble and disciplined. This one is a mixed bag for me. This one is hard because I see both sides of the mirror, as you will. On one hand, if you really think you're smarter than the market, odds are statistically you're not. So you're sort of swimming upstream, right? But on the other hand, the way you make the huge returns in investing is when you are contrarian or you see something that others don't, maybe because you have access to inside, call it expertise, domain level knowledge, or you're just, you know, looking in the right direction in terms of emerging technologies or who knows what. So it's not like a black and white picture, but staying humble, knowing that you something like, okay, odds are that I'm not right, or odds are that the market is right and I'm not the smartest guy in the room. That humility probably will keep you from making the bet too large or blowing yourself up or even noticing cracks in your thesis.
Yeah, exactly. And like being a successful investor isn't about like being this like dazzling like lone voice that has this one opinion. Like it can be like that, but that's like the exception. Most of the time, it's about staying the course, having a long-term view, just getting compound interest working for you. And I think that's the angle where I'm bringing in my movie reference for this law. And this is a movie I haven't seen since I was a kid, probably. Mary Poppins from 1960 something. And there's a scene in Mary Poppins, a Google search today reminded me about, that where Dick Van Dyke convinces one of the children, to deposit their money in the bank rather than spending it on sweets. And the kid's not happy about it because he wants to enjoy it right now. But Mr. Dawes, Dick Van Dyke's character, wisely explains that by putting the money aside, then it'll grow and compound in the bank, and then he'll benefit in the future, be able to buy a lot more sweets and toys in years and years to come. So yeah, I think that kind of being humble aspect is can be important. But it does, you're right, it does sort of stand in conflict a little bit to like do your own due diligence, don't follow the crowd. But I think with nuance, these two things can kind of coexist.
That's where the art of it comes in. This is one of those where the longer you do this, you could do both. You could stay humble and sometimes see things that others don't and know when you're right and when you're wrong.
Yeah, exactly. Now, I wanted to get a horror movie into this, so I've had to force this one in a little bit, but I hope you're going to like my analogy or my metaphor, whichever it is. So the seventh law is build a resilient portfolio, which is essentially about where we started the conversation an hour ago about being diversified. Don't put all your eggs in one basket. And you know, the horror movie where the situation became much worse because they didn't have diversified income streams. I know you might think I'm making a bit of a leap here. Jaws, right? Like ostensibly Jaws is like a story about like a giant shark that like chomps swimmers, and then, you know, we're going to need a bigger boat and we get out there and like slay the Jaws shark. But really it's a story about like the greed of the town and how this disaster became much worse because this beach town somewhere in the, where is it, Florida? I've got no idea. Probably somewhere in the States. This beach town was like so dependent on their like seasonal income from holidaymakers and like everyone enjoying the beach that the mayor or whoever, the guy, like the bad guy in the movie, refused to like shut down the beach and shut down everything and make it clear that like it's like danger in the water because that would have wrecked the economy. And so like the lesson there was things got much worse because the town of Jaws didn't have like other income streams and they made a bad situation much worse.
Right. And that ties in with one of the first laws, right, which is don't invest more than you could afford to lose or something like that. Mm-hmm. So resilience comes in many shapes and forms, but just think about it in Jaws' terms, right? If you weren't the greedy commercial owners of this town, then a shark comes along, you're like, cool, okay, I'm heading off and I'm going to go eat some ice cream at the other town over until the shark goes away, right? Instead of being forced to swim and get your bits chopped off.
Hey, speaking of which, bizarrely, so I just literally just occurred to me, we had a terrain park lesson in Avoriaz last week when we were skiing, myself and a couple of buddies, and our terrain park instructor he was an incredible skier. He only had one leg, and we were towards the end of the day, and he's been doing like backflips and like crazy cliff drops and all sorts of stuff, like the half pipe. He's teaching us to do this stuff. And we're chatting on the chairlift going up. And I'm like, oh, how come you've only got one leg? He was surfing and he got bitten off by a shark.
Oh my God.
Holy hell. And the guy literally, went into I'm not panicking control mode. He was a pretty smooth, smart, handsome French dude. And he'd managed to paddle himself back to shore, shout for help, and then got rescued. And now he's like a world-class skier with one leg.
You want to talk about more horror?
Yeah, let's talk about more horror. Go for it.
This is, for me, the most horrific one.
Oh.
And I would maybe put this at number one, I would make this rule number one. And I broke this rule when I was in my 20s, which is understand the deathly perils of leverage, meaning borrowing money to invest. So you're paying interest costs, and then the upside is magnificent when you're right, but the downside is steeper and accelerated when you're wrong. And because of things called margin calls, where when the lender can basically tell you they want their money back now, you're then forced to sell at the bottom. Many people have lost their entire life savings this way. I've lost way more than I'm afraid to admit. And so for this reason, I'm happy to be on the record to say, do not, under any circumstances, use margin to invest. Period.
Yeah. And there's lots of different ways you can make leveraged bets. Like at the simplest, you could just buy a 2x ETF or something, essentially some product that tracks some other thing, like an index or a company. You can buy a 2x or a 3x Nvidia ETF if you like. But essentially this thing is designed so that when the stock goes up, it goes up by 2 times or 3 times. When the stock goes down, it goes down by 2 times or 3 times. Those are short-term products that you might rationally own for a good reason, for a trading reason. But these are not a lot of things to hold for the long term. You will lose all your money if you hold those kind of products.
The only, I would say, asterisks would be once you obey rule number one, which is never use leverage, it is in the realm of more advanced investors to say allocate something like whatever, you pick some percentage of your portfolio that you are literally okay going to zero because you've already made it and you're doing well everywhere else. Call it 5%. And then within that 5% bracket, you might say to yourself, okay, I'm going to take some real big swings based on my due deep diligence. And if I'm right, great. And if I'm not, no skin off my back, because that's what I expected would happen. But that's I would say not till you've been investing for 10 years and you have a lot of experience and you're financially sound, and this is all playing with house money, so to speak.
And our movie link for this one is The Big Short from 2015. Awesome film that teaches you a ton about the way the financial system actually works. Just really, really good. And it's a bit odd the way leverage functioned in the great financial crisis, but essentially that was the underpinning of how everything really went up the wazoo. Too many people, the example in the movie is they find a stripper who owns 10 houses or something. She's leveraged to the hilt because she's sort of playing property, and so she's over leveraged. If as soon as things start to retract, and then all of these dubious mortgages which were not backed by fundamentals, the people's ability to actually pay the mortgage, they were all repackaged into mortgage-backed derivatives, complex financial products, and then resold to other banks, and then leveraged. So as soon as one tiny straw broke at the kind of housing level and people's debt started going bad, that brought down the entire financial system pretty much. So yeah, great movie, a ton of investing lessons in there, but one of them is the danger of leverage, both for the householder, the consumer, and for the big banks who kind of levered their books off the back of these bad loans.
And maybe bad news for humanity. I'm convinced that the market is way over leveraged right now because human beings can't help themselves. And that the lessons we learned in 2008, that nearly brought the world to a financial collapse. We're right back where we were. I guess it's now 17 years ago. And it just won't surprise me, like, for this thing to happen again. We got to taste a little bit of it with that Japanese trade carry thing, right? People over leveraging in order to take advantage of a financial arbitrage situation thing. And then you saw the market just plummeting at the hint of like this massive unwind that would happen with margin calls, triggering more margin calls. And it's just ugly. And rule number one, don't use leverage.
Yeah. Well, we're nearly at the end of our 10 laws, but rule number 9 is resist the urge to rearrange your trophies. So this, a bit of sort of jungly language, really. But what we were talking about there was like, let your winners run. Don't, like, you want to stay diversified and you need to rebalance your portfolio. But part of the art of portfolio management is also like recognizing when you have a strong performer in your portfolio and giving it a chance to compound. Like, you can't have 100 bagger or a 10 bagger, i.e. a stock that delivers like 10 times your investment, if you don't let it double first because you keep trimming it and whittling away at it. Obviously, caveated, you got to manage the diversification. You can't have 46% of your portfolio in EOS, like a particular podcast co-host I know.
Funny you say that, because as per my resolution in 2025, I said I'm not going to sell a single share of EOS. And as the story unfolds, I'm going to try to duplicate your ISRG holding, Intuitive Surgical, that you said you've never sold at all. And I'm on the record as saying I expect to be a shareholder still, not having touched a single share in my King of the Jungle portfolio in 2028, 2029, 2030, as long as the thesis still is unfolding. I will resist trimming it, no matter how, so to speak, within, well, God, there's all these caveats, but within reason. Like, if it goes to $100 a share and 20Xs or 50Xs, I'm going to sell. But like relatively speaking, no selling from me because of the confidence. And like you said, it takes time for the massive money to be made.
Yeah. So I don't have a movie for this, but I've got a TV show kind of linkage for this. Have you seen Silicon Valley? Ran for about 5 years in the mid 2000s. Yeah. Super. Oh, you say you have not, you said. Oh, so I misheard you.
I have not.
It's great.
No.
I must have watched it through like 3 times. It's a really good TV show. Especially if you're a tech guy. It's hilarious. Like, it really was just ripping the thing out of like all of the big tech stuff at the time in like the 20 teens. Well, like at the core of the show, it sort of evolves, is this guy, Richard Hendricks, he's like a world-class, super developer guy. And he's got like a startup called Pied Piper, and it evolves what they think Pied Piper is along the journey. But essentially, like, Richard, the founder, recognizes the core of this thing is its revolutionary compression algorithm, in outside in or inside out. And then throughout like the 5-year TV show, all the seasons of the show, like, he's constantly fending off various acquisition attempts from Hooley, Gavin Belson at Hooley, who's like, can see that his business is going to get wiped out by Pied Piper because they've got an inferior compression algorithm. Back Manatee try and like end up with a significant stake unexpectedly in the company. But the founder, Richard Hendricks, like, clings on somehow to the core of this thing because he can see the long game. And he can see that if he loses control of the IP around his algorithm, which I think he does briefly and then gets it back again, like, he won't be there for the compounding and like the long-term benefit to accrue to, him and his team. So yeah, do that. Manage your portfolio, manage your diversification. But if you're onto a good thing, like, let it run, let it go, and let it deliver for you.
I'm sorry, I have to say this. The art of it, though, because that's simple in theory. The art of it is that, when I think about selling Amazon, like in 2000 and whenever I sold it, and buying it back higher and selling it again, there are periods of every company's majestic rise where the stock craters and things are looking awful and you realize you should have sold. And many companies do. Like, I mean, for quick, easy examples, Zoom, right? When it was $500 a share, if we followed this principle, you'd be like, never sell because, right? But now it's $60 a share and the world has changed. And so it's not like it's an end all and be all, because you have to check that the thesis is still intact. And if you do that, then speed bumps are not enough of a reason to sell if the overall picture is still in play. With Zoom, it became pretty obvious you can't sell to more than the world's population which already had Zoom, right? So, but that's a whole different thing.
No, but you're exactly right. That is the skill and the nuance of being like a real investor. It's understanding all these laws and many others. It's understanding the interplay and how they're contradictory sometimes, but being able to like thread the needle and navigate that. Knowing the difference between like a Zoom and an Amazon at its early stages is critical. I made good money in Zoom and I got out. I didn't catch the peak, but I got out before things went too ugly, because it became apparent to me, because I was in like an investing community and chatting to Matt Cochran about Zoom. Like, he made the great point that this shouldn't be a company, like it's a feature, and it's in, Teams, and it's in like so many other products. Like, does this really deserve to be a deca-billion-dollar company? Probably not. And the growth expectations that were built into it were just unsustainable, because that was like the world we were living in COVID, right? It looked like work from home was here to stay and to grow. But now, like, we're turning back on that. So yeah, the art is putting all these things together.
Indeed.
Do you want to pick us up on our final law of the jungle?
Sure. This is maybe easily in my top 5 movies of all time. Beware of get-rich-quick schemes. Sponsored by none other than Mr. Wolf of Wall Street himself, Jordan Belfort, played by Leo DiCaprio, which I will go on the record to defend and say that is the best acting performance I have ever seen, and nobody's is better if you look at it just from that angle. But to our business, invest in real companies that do real things that help people, as opposed to gambling and ripping people off and grifting and generally being a douchebag. Like, pretty good set of rules for life in general. God, I love this movie.
And like, you quote it often on the podcast. What's the quote you gave us a few episodes ago? Like, it was from DiCaprio, and he's like pitching this like BS stock to like some guy over the phone, and he's like the only do you know the quote?
Yeah, the only mistake you'll have made is to say you wish you had bought more.
Right, exactly.
Or something like that. Like that. It's not the exact quote. This is a cynical view of humanity, but there are a lot of grifters out there. There's a lot of people that think of things as a zero-sum game. Their intention is to steal from you or take your money. And unless you have a fundamental solid ethics where you're investing for the right reasons with the right frame, which is to create value and be rewarded for the act of creating value, then you're going to be taken by one of these grifters, or you might be one yourself. And that's not something that the monkey and the badger support on any level whatsoever. Live by the sword, die by the sword.
Absolutely. Yep. See, Christoph's banging his chest as they were in the movie. Very good. So
you know what, Badger? Those are rookie numbers.
Yeah,
those are rookie numbers.
So you know what, Christoph? I think when we wrote our 10 laws of the jungle, I think we missed a law, and we sort of talked about it, but I want to bring it into play now and make it an official, like, 11th law of the jungle. And this is that, like, investing isn't a solo game, right? It's better with friends. It's easier with friends. It's easier as part of a community because, like you said, you can pitch your idea on patreon.com/Wall Street Wildlife and get feedback from other investors, some of whom might already be shareholders, some of whom might have direct experience of the actual products and services the company provides. You just bounce your ideas off other folk who are interested in this same kind of fun game of trying to find like the world's greatest companies. It just, 2 heads are better than 1 and 200 heads are better than 2, right? It makes so much sense. And we do have the seed of a great community at Patreon, so do check it out.
Wisdom of the crowds. There's something to that. One. Also, it's just more fun. This is one of those things, you know, how people burn out when they either go too hard at one thing alone and then they just can't sustain it, or they make a mistake and then we've seen this. How many times have we seen this in all the market cycles, right? People get excited when it's up, then it goes down and they say never again. Then they drop out, right? They drop out, the market goes up when they're out of it, then they come back buying at the top. I mean, and just like burning your money away, as opposed to saying, no, I'm sort of in this not just to get rich and wealthy, but to have a good time, to make friends, to make relationships, and that will help you stay in the game longer. And like, what's life about, really? It's not about the money. It's about the journey, blah, blah, blah. I'm not going to get all hallmarky on you, but I mean, really, this is huge.
Yeah, like you said, it makes stuff more fun. It makes it easier, and you'll make better decisions as a result of being part of a community. And maybe a nice sort of financy, community-oriented movie is the Christmas classic, It's a Wonderful Life, which reminds us that true wealth lies in community and relationships and having a positive impact on others rather than just pursuing financial gain.
Yes, and no disrespect to YouTube or our YouTube commentators, but I gotta say, in this moment of our own journey, when we get some requests for some comment, you know, on YouTube, because it's such a huge, big platform and we don't often know who it is that's asking something, it just isn't the same as when one of our own community members on Patreon does. And it has nothing to do with money, or it has nothing to do with like incentive. It has to do with like, there's people that are in, and then there's everybody else. And people who are in your tribe, you know them and you respect them and you will take the time, and like, it's just a whole nother thing. So if you're listening to this from YouTube and you're not in our community, consider that it's just like a structure of human nature. Like, we treat others more thoughtfully when they're one of us, so to speak. One of us. One of us.
You do love that movie. Great stuff. Well, I hope you got some value out of our little review of the 10 laws of the jungle, or the 11 laws of the jungle. If you do want to go read them in full and see our pretty pictures, go check them out at patreon.com/Wall Street Wildlife. You can find it on there as a freebie download. You don't need to sign up to get that. Christoph, anything you want to close us out with?
Check out finchat.io, the program. I love it. We both love using it. It's kind of our one-stop destination. It's what I used for Avita Medical to go over the latest, transcript that they did at a medical conference. It was so cool. Like, the transcript was already there. You see it transcribed, and you could also play the recording, and it highlights the section of the transcript. So it's just AI stuff doing finance, and it's making the finding of information so much easier, so much more direct. And like, you have nobody has an excuse anymore to like not know the answer to some investing question, really, if you use a product like FinChat. So check it out. Use Wall Street Wildlife, or is it just Wildlife?
Finchat.io/wildlife to get our promo discount code. Great stuff. All right. Until next week, are you ready to become a beast of an investor?
Your journey starts here.
A reminder that the people on this program may hold positions in the companies that are mentioned. Buying and selling stock carries financial risk, which could include loss of capital. The views in this program should not be taken as personalized advice. Before acting on any of the information provided, listeners are encouraged